Good morning, everyone, and thank you all for joining in for this interesting session on Trade Smart in F&O with option trading strategy. Firstly, let me introduce myself. My name is Tarang Solani. I'm the product manager in HDFC Securities, and I will be the host of this session where we will be covering the various option trading strategy to play in this kind of a volatile market or any kind of a volatile market. So markets would be in a volatile range, but how we play in the market that is a very important aspects where we'll be touching upon in today's session. So what we'll be covering is we will be covering first the basics of options, how you can trade in options, what are two types of options like call options, put options, and apart from that, we will also cover different strategies in different market views. So suppose you have a bullish view, then what kind of a strategy you can do? Bearish view, you have a view that market would be in consolidating in a range bound movement, that is, it would be consolidating. Then in that also you can use some kind of a strategy to play out that view, and also in a view that you expect a big move in the market in either direction, that we call as a volatile view. If you have that kind of a view, then what kind of a strategy you can prefer to trade upon that. So we'll cover each and every scenario in different market views, so that in different views how you can play in the market with the strategies that we'll look upon. So let us begin with the session. First, we'll touch upon the options. Now, there are two types of options, as you will be knowing it, that is call option, and the second one is put option. Now, in a layman language, if you are bullish, you need to buy call option to take advantage of your bullish view, and if you are bearish to buy, you need to buy put option to take advantage of your bearish view. Sorry. Now you can take advantage of bearish view by selling call option, and also you can take advantage of bullish view by selling put option. So before starting, can anyone write on the question answer section, is my voice visible to you all, and is my screen also visible? Sorry, is my voice audible to you all, and is my screen visible? Can anyone write? Okay, thank you. Thank you very much. So as we mentioned, there are two types of option. One is call and put. If you're bullish, you need to buy call option to take advantage of your bullish view. If the price of the particular stock or index you buy, if the price of that buy, the call option price will also increase, thereby benefiting you. And same way, if you are bearish, if you are bearish in particular stock or index, if that particular stock or index falls, then put option price will increase, thereby it will benefit you if you buy put option in your bearish view. And same way, you can take advantage of bearish view by selling call option, and also you can take advantage of your bullish view by selling put option. Now we will understand in detail in the further slides with examples, so that you come to know how you can play out. Suppose I have a bullish view on the market, and I feel currently Nifty 18,200, 100, I feel that it will go above 18,500 levels. I have a bullish view, so what I do is buy 18,500 call option at 150 rupees. So here 18,500 is known as the strike price. There are various strike price which are available in the exchanges. Based upon that, I will choose how comfortable I am in the view that I have. If I have a view that Nifty will go above 18,200, then I will choose for 18,200. So depending upon the view you have, you can choose the strike price. So for example, I have just chosen 18,500 call option, which I bought at 150 rupees. So here, since I'm a buyer of an option, my maximum risk is just 150 rupees and not more than that. And also the capital required to buy this option is only 150 rupees into the lot size for one lot of Nifty is 50 shares. So net 7,500 is my maximum investment of buying call option. However, my risk is also limited. That is 7,500 is only my maximum risk if in case my view doesn't go right. That is if Nifty doesn't go above 18,500 levels. However, my loss would be unlimited if in case, my loss would be limited, that is 150. My profit would be unlimited if in case my Nifty goes in my direction, and if it, how much ever it goes above 18,500 levels, I would make unlimited profit. So that's the beauty of the options. Basically, your investment capital required is also very less. Your risk is also less, and your reward is unlimited if in case your view goes right. So here made you explain that if Nifty closes on or below 18,500 levels, you will lose not more than 150 rupees per share. But if Nifty starts moving up and it goes how much ever, suppose it closes at 19,000 levels, then you will make profit of 350 rupees per share on an investment of 150 rupees. So around 2 times of your investment you can make if in case your view goes right. And on the expiry day, if Nifty closes on 19,000 level, then you will make around 350 rupees. How 350? So difference between 19,000 and 18,500 is 500 points, and you have already paid 150 rupees. So we'll deduct 150 rupees from 500. So net you will be making 350 rupees. So another example, as I told, if you are bearish, either you can buy put option or you can sell call option. So here I have a view that Nifty at no cost would go above 19,000 level. That means I'm bearish about 19,000 level. So I am selling 19,000 call option at 100 rupees. So since I'm a seller of an option, I will receive this 100 rupees as a premium. And here the risk reward functionality will just get reversed what it was in the buying of option. So if you are a seller of an option, your risk is unlimited if in case your view goes wrong. In this case, if Nifty starts moving above 19,000 level, that means you will be exposed to unlimited risk, how much ever it goes above 19,000 level. But if Nifty closes on or below 19,000 level, you will make a limited profit, which is 100 rupees per share. That is what you will be making it. So here in the payoff diagram, if you can see, if Nifty closes on or below 19,000 level, you will make 100 rupees per share as a profit and not more than that. However, if Nifty starts moving above 19,000, that means your view went wrong, and you basically how much ever it goes above 19,000 level, that much amount of loss you will be incurring. So suppose on expiry it closes at 19,400 and you still hold on to your position till expiry. So you will be making 300 rupees per share as a loss if Nifty closes at 19,400. How 300? So difference between 19,000 and 19,400, that is 400 points. That means it went 400 rupees against your move. So basically 400 rupees minus 100 rupees is the premium which you have received while selling this option. So here, since you are exposed to unlimited risk, the margin requirement to sell this 19,000 call option would be also high. Approx 65-70,000 rupees of margin would be required. So the capital required to sell of options is always high because you are exposed to unlimited risk. Hence, to safeguard that, exchange will charge you higher amount of margin. However, your profit is just limited to the premium which you will be receiving it. And at what scenario your profit would be if Nifty closes on or below 19,000 level, you will make profit of ₹100 rupees, that's for sure. So that was about selling of option. Now we'll move to put option. So what is put option? So again, if you have a bearish view, if you want to take advantage of your bearish view, you can buy put option. So if the particular stock or index falls, the price of the put option will increase, thereby it will benefit you. And again, the put option can be looked upon like an hedging insurance. So how basically, suppose you have an insurance policy, vehicle insurance. So how does it work is basically, again, whenever you buy any insurance, you need to pay premium to buy that insurance. Here also, if you buy any put option of any index or symbol, so you need to pay premium to buy that put option. So again, coming back to insurance, that is your vehicle insurance. If you buy any vehicle insurance, that insurance company will assure that if anything happens to your vehicle, insurance company will compensate. So same thing, if you are buying any put option, that suppose you are buying 18,000 put option. So that 18,000 put option is an insurance policy to you that assures that how much ever if Nifty goes below 18,000 level, you will make, I will compensate you. And same way in a particular expiry, if that 18,000 level, it doesn't go below 18,000 level, then your premium is gone. Same thing like your insurance, every year, if nothing happens to your vehicle, then your premium is gone. And again, in the next year, you need to pay a fresh premium. So this is how it works in the financial markets also. So put option is like an insurance policy to you. It ensures whatever put option you buy. So it ensures that if it goes below that level, then it will compensate to you. So here I have given an example of 18,000 put option. Suppose you are bearish on market. So you buy 18,000 put option at 120 rupees. So here it states that if it goes below 18,000 level, since you are a buyer of an option, your profit is unlimited. How much ever it goes below 18,000 level, you will make unlimited profit. But if it doesn't go below 18,000, if it expires on or above 18,000 level, then your loss is just restricted to 120 rupees per share and not more than that. So here in this payoff table and diagram, you'll be able to see that if Nifty closes at 17,500, at that point on the expiry day, if you still hold on to your positions, your maximum profit would be 380 rupees per share. That means you have paid 120 rupees as an investment. Also, your requirement is 120 rupees per share. And if it goes to 17,500, you will earn 380 rupees per share. That means around 3 times of your investment you will be making profit. So that's the beauty of buying of option. However, you have to get a good timing of buying of option. If your view goes right, you tend to make unlimited profit. But if your view goes wrong, your loss is 120 rupees and not more than that. So how this 380 rupees came off at 17,500. So difference between 17,500 and 18,000 is 500 points. And you have already paid 120 rupees to buy this 18,000 put option. So net you will be making 380 rupees if Nifty expires at 17,500 levels. Now let us understand about selling put option. So as I made you understand, if you are bullish, either you can buy call option or you can sell put option. So here I have a view that Nifty at no cost now will go below 17,500 level. So what I do, I will sell 17,500 put option. That means I am bullish above 17,500 level. So I will sell 17,500 put option at 50 rupees. So in this case, since I am a seller of an option, my margin requirement would be high. Approximately 80,000 rupees of margin would be required, because since you are a seller of an option, you are exposed to unlimited risk. If Nifty starts moving below 17,500 level, your risk is unlimited. But suppose if it expires on or above 17,500 level at any point of level, your profit would be capped at 50 rupees per share and not more than that. So here you will be see if Nifty starts moving below 17,500 level, you are exposed to unlimited risk. The loss is unlimited. But if Nifty moves on or above 17,500 level, you will get 50 rupees per share as a profit and not more than that. Now, after seeing this example, you will see why people will sell options. Rather, buying of option is very lucrative. Risk is also less. Your reward is also unlimited. Investment is also less. Why would people sell options, being it call or put? So selling of option is a probability game. Suppose you have a probability that 99% chance there is no, that is Nifty would not go below 17,500 level. Then there's 99% chance to pocket this full 50 rupees as a premium. So it's a very good probability game. More and more participants, of course, they buy the option, but probability of earning money in selling of options is quite high compared to probability of in buying options. And that's why if you see the capital requirement is very less compared to selling of options. Compared to for buying of options, selling of options, capital requirement is very less, and hence basically very few people earn money from buying options. But by selling options, the probability of winning is quite high. But you have to adhere to all your risk parameters. Basically, firstly, you should have a sufficient amount of margin to sell the options. Secondly, you should play with a stop loss. You should not wait till it if it goes against you, you should square off your position. And these three parameters which you need to be careful of whenever you are selling the options, because if you don't be careful and if it goes against you, then you are exposed to unlimited risk that you have to be careful of. We'll move upon the option trading strategies. So option trading strategy is a smart way to participate in any kind of market swings. So if you have market swings like bullish, if you have a view, you have a bearish view, you have a range bound view or a volatile view, options has something to offer for you to earn income from any kind of a view on the market. It is only in options where you can make money in every view in every particular view on the market, and that's why it's an highly tradable instrument on the exchanges, because you can trade in any kind of a view on the market, and if your view goes right, you will make money. So if you see, majority of the volume which is coming on the exchanges are coming from the options. Approximately 80 to 90% of the volumes which are happening on the exchanges comes from options only. It's because of this reason only that you can trade in any kind of a market scenario through different option trading strategies. So let us look about one by one based upon the view which kind of a strategy to follow. So this is a basic strategy which we'll be covering where you can follow based upon the view on the market. So firstly, if you have a bullish view on the market, the first strategy which you can do on the bullish view is bull call spread. Now, what is bull call spread? So, and when to initiate? The bull call spread can be initiated once you expect an up move in the market and want to reduce the cost. And how to use this strategy? You can use this strategy by buying one at the money call option and simultaneously selling one out of the money call option of the same expiry. You can use this strategy. So here, if you are selling of one out of the money call option, that means you are reducing cost, because whenever you sell any option, you will receive the premium, and whenever you buy the option, you have to give premium. So here, what you are doing is you are receiving a premium by buying an option, and by selling, you are compensating some part of it and reducing the cost. So that's the main motto. Basically, you are reducing your risk, you are reducing your cost by doing this strategy. This is called a hedging strategy or spread strategy. Time frame: whenever you do this strategy for a monthly expiry, your time frame should be at least for 7 to 14 days to be profitable. Exit rules: if you're playing it for an event and if the event is unfolded, you should exit the strategy. And second thing, if you have reached a predefined level, the predefined level would be the options which you have sold. If you have reached that level, then either you should book profit into the strategy. If you still want to hold on to your strategy, you can initiate the fresh strategy again by rising your strike prices. So let us understand with an example. Now suppose Nifty is quoting at 18,500 and you feel that the market will go up. Now Nifty have already risen by so many points, and if you feel that market will still rise, then you can do this strategy called as bull call spread. So what you do, if you buy 18,500 call option at 200 rupees, and simultaneously to compensate some part of its cost, you sell a 19,000 call option. Well, you will receive 120 rupees. So net from your house and from your pocket, it's only 80 rupees which is at risk now. Unlike if you just buy call option and doesn't hedge your position by selling call option, then your risk would have been 200 rupees if in case your view goes wrong. But what you have done is you have hedged your position by selling the call option. You have reduced your cost by getting 120 rupees as a premium by selling 19,000 call option. At net now from your house, 80 rupees is at risk. So if if Nifty closes below 18,500, your view goes wrong, you won't lose more than 80 rupees. However, since you have sold the call option, your profit will be capped about 19,000. About 19,000, there would be no incremental profit will be earning it. So here your break-even point, but obvious, would be 18,580 because 80 rupees is your cost. So you will add 18,500 with 80 rupees. So net 18,580 would be your break-even point. And maximum profit for this strategy is 420 rupees. If in case Nifty closes on or above 19,000 levels, you will make 420 rupees per share as a maximum profit. How 420? So you should deduct 19,000 is the highest strike price, and you should deduct 19,000 from the break-even point. So net you will be receiving whatever you receive, it's your maximum profit. And maximum loss is the cost which is involved to buy the strategy, that is 80 rupees per share is your maximum loss. However, margin requirement for this bull call spread would be in the range of 20 to 30,000 for index options, and 40-50,000 would be for stock options. This is a random margin figure which we have given. You can check to our HDFC securities margin calculator to analyze how much margin would be required to do this strategy. So for this strategy, we have calculated it was approximately 22 to 23,000 rupees of margin would be required for doing this strategy. So here is a payoff diagram. Basically, here is a payoff chart in the right hand side, and the left hand side, if you see, is a payoff table. So if Nifty closes on or below 18,500 level, if you do this strategy, you won't be losing more than 80 rupees per share. But if it starts moving up, suppose it closes at 18,000 800, you will make 220 rupees per share as a profit. How 220? So you need to deduct 18,800 from your break-even point is 18,580. So here, after deducting that, net what will be remaining is your profit. So 220 rupees per share is the profit if Nifty closes at 18,800. And since Nifty closes above 19,000, your incremental there won't be any incremental profit, and maximum profit would be 420 rupees per share. So it's a very good strategy if you want to reduce your cost in kind of volatile market. If you just don't want to buy options, which will take you to risk. If in case your view goes wrong, it is possible that all of your options premium will get vanished. But if you simultaneously sell the options, you will get some cushion of the cost involved in it, and your cost will also get reduced. And hence, whenever you have any kind of a bullish strategy, if you are not confident of, it is always recommended to go for a bull call spread, wherein you can reduce your cost and simultaneously, if the market moves up, you can benefit from it. Now we will go upon bearish strategy. It's just in what we saw on the bullish strategy. The same thing we have to do in the bearish strategy, which is called as a bear put spread. Bear put spread. I'm sorry. It is called as a bear put spread strategy. Now, what is bear put spread strategy? Let us understand. So when to initiate this bear put spread strategy? When you expect a down move in the market and want to reduce the cost, same way what we have learned in the bull call spread, when you expect a up move in the market and want to reduce the cost. In a bear put spread strategy, when you expect a down move in the market and want to reduce the cost, you can initiate this strategy. How to use? Buy one at the money put option, and simultaneously to reduce your cost, you can sell one out of the money put option of the same expiry. Time frame should be 7 to 14 days. If you are doing for a monthly expiry, your time frame should be 7 to 14 days, which you need to keep to be profitable in for this strategy. Your exit rule should be once the event is over, or if you reach any kind of a predefined level, you should exit this strategy. So here it is an example. Suppose Nifty is quoting at 18,500, you have a negative view on the market. So what you can do, you can buy one 18,500 put option. You can buy one 18,500 put option at 180 rupees and simultaneously sell 18,000 put option at 80 rupees. So once you buy 18,500 put option, you have to give 180 rupees as a premium. And once you sell 18,000 put option, you will receive 80 rupees as a premium. So net your cost have reduced to 100 rupees. Now your break even point would be 18,500 minus 100, that is 18,400 would be a break even point. Below this, your profit will start. And since you have sold 18,000 put option, as I mentioned, your profit will also be capped. Above 18,000 put below 18,000 put option, there won't be any incremental profit. So here your maximum profit for this strategy is 400 rupees. That is 500 is the difference, minus 100 is the cost. So difference between 18,500 and 18,000 is 500 points, and 100 is the cost involved. So net maximum profit would be 400 if Nifty closes on or below 18,000 level. However, your maximum loss is 100 rupees if Nifty closes on or above 18,500 level. Your view goes wrong and Nifty starts moving above 18,500 level, then you won't lose more than 100 rupees per share in this strategy. However, as I told, margin requirement for this kind of a strategy for index like Nifty, which I have showcased you, this strategy would require anything between 20 to 25,000 rupees only, not more than that. So that was all about bear put strategy. Now we'll move upon different view, that if you have a volatile view on the market, and in this kind of a volatile view, what is volatile view? First of all, you have a view that Nifty or any kind of a stock or index will show a big movement in either direction. In this scenario, what we'll do is basically you need to do a strategy where if it moves, any kind of a big movement is expected, then you can capture that big movement with this strategy. Then how you can do this strategy? So we have a strategy called as long straddle strategy. So what you can do in long straddle, so let us understand. So long straddle is a delta neutral or market neutral strategies. That means whose profitability does not really depend on the market direction. Long straddle is perhaps the simplest market neutral strategy to implement. So once implemented, the P&L is not affected by the direction in which the market moves. The market can move in any direction, but it should show big move in that direction. So as long as the market moves, a positive P&L is generated. So in short, if you don't understand this brief definition, in short, long straddle strategy is something like if you have to do a strategy wherein it should capture that amount of movement, and after that you will start making a profit. So let us understand with an example. And also what are the rules of entry and exit. So when this kind of a strategy can be created, so long straddle can be created on intraday and positional basis in weekly and monthly options. Ideal strategy if one expects spikes in implied volatility in the near future. If the implied volatility increase, the premium price will automatically increase. So if you expect that will increase, then the long straddle strategy is an ideal strategy to look upon. Can be created during any important event when IVs are very low and big movement is expected. Very effective in Nifty and Bank Nifty on day of weekly and monthly expiry, where you usually see big movement is seen in both the indices on that day. So if you see this Thursday also, we have seen a very large movement in both the indices this Thursday. Then if you see the premiums of the expiry of any options on the expiry day, the premiums is very low. So if you do this kind of a strategy and there is a big movement expected, you will benefit from this strategy. You can do it in weekly or monthly expiry also. Now, what are the exit rules? You should keep a stop loss of 10 to 20% of the total premium outflow, and you should book profit if the total premium increases by 20 to 30%. If implied volatility falls, then despite index showing sharp movement, the premiums won't go up, and it is better to exit the strategy. So here in the long straddle, what you have to do is you have to buy one at the money weekly or monthly call and and also buy one at the money put. You have to buy one at the money call of monthly or weekly, and simultaneously buy one at the money put option of monthly or weekly expiry. That should be of same strike price and same expiry. So let us understand Nifty 18,000. Suppose Nifty is quoting at 18,500. And you buy 18,500 call option at 120 rupees and simultaneously buy 18,500 put option at 150 rupees of the same expiry. So your net outflow would be 120 rupees plus 150 is 270 rupees is a net outflow of the premium. Now what you have to make sure that Nifty either should go up or should go down, but it should go up by more than 270 rupees to be profitable, and it should go down by more than 270 rupees to be profitable. So your lower break-even point would be 18,500 minus 270, that is 18,230. So if it goes below 18,230, your profit will start and it is unlimited. And higher break-even point is 18,500 plus 270, that is 18,770. So if it goes above 18,770, your profit will start, which is unlimited profit because you are a buyer of an option. So your maximum loss is 270 rupees per share if Nifty expires dot at 18,500 level. Then your both call and put premium would be zero, and you will be losing full 270 rupees as a premium. That's your maximum loss. But your maximum profit is unlimited, how much ever it goes below lower break-even point, or if it goes above higher break-even point, how much ever it goes, your profit is unlimited. Now let us understand with the payoff diagram and chart. So here, if it expires between 18,200 to 18,800, you will incur some kind of a loss. But if it starts moving below 18 to 30, that is your unlimited profit is there, how much ever it goes below 18 to 30. And suppose if it goes above 18,770, that also there is an unlimited profit, how much ever it goes above 18,770. So it's a good strategy to do in a volatile market where you expect a big movement, especially on the results day, where we do see a big movement in a particular stock if the results are bad, which we have seen in Infosys. We had seen there was a bad result and it did went down by 4-5%. And if you have done this kind of a strategy, you would have profitable. But make sure you first check the implied volatility of this strategy. Now post the result, you do see that implied volatility comes down. So don't do any kind of a strategy if the implied volatility is very high, because even if the market or particular stock for the strategy which you are doing it, if that shows a big movement, then there are high probability that you won't make much money into that. One more example to play out is the last view, that is the range bound view on the market. Suppose you have a view that market would consolidate, which we did saw in last to last month. Market was been in a very narrow range between 16,800 to 17,200. Market was been consolidating, and if you want to make money in this kind of a market scenario, which we call as a range bound view, we have a strategy for that called as short straddle. The short straddle is completely opposite of what we learned about long straddle. So when to create this strategy is opposite of long straddle, can be created when there is range bound movement expected in stock or index. Very effective in low volatile stocks. So low volatile stocks like Coal India, there are stocks where we have seen very low volatility, so that can be very much effective for this kind of an strategy. How to use this strategy? It is, as I told, it is complete opposite of long straddle. So here, by buying, you will do selling one at the money call option and simultaneously selling one at the money put option of the same strike price and the same expiry. What should be your exit rules for this strategy? So you should keep a stop loss of whatever premium you will be receiving it. Since you are selling both call and put options, so you will be receiving a premium. You should keep a stop loss if 20 to 25% of the total premium increases. Whatever premium you have short sold it, if the total premium increases by 20 to 25%, you should keep a stop loss and you should exit from the strategy. And you should book profit if the particular premium decreases by 40 to 45%, and you should basically exit from the strategy or book profit. So let us understand with the example. So your first example, this is what we have given for Bank Nifty. So here, what you have to do, this strategy, long straddle, where trader sells both call and put of the same strike price and expiry to benefit from it, trades in a range. Strategy is sell one at the money call plus sell one at the money put of same strike price and expiry. So here I have taken an example of a Bank Nifty which is currently quoting, suppose an example is quoting at 42,000. So here what I do is I sell 42,000 call and 42,000 put of the same expiry, and there is also same strike price. So I will receive 500 rupees by selling 42,000 call, and I will receive 400 rupees by selling 42,000 put. So net I will be receiving 900 rupees by selling this 42,000 call and put of Bank Nifty of the same expiry. Now what will be my break even? So break even, suppose it closes. Now what you have to do, you have to make sure the market consolidates between this level. So 42,000 minus 900, that is 41,100 is my lower break even point, and 42,000 plus 900, that is my 42,900, that is my upper break even point. So if market consolidates between 41,100 to 42,900, I will make some kind of a profit in this strategy. However, if it falls below this lower break even point, or if it rises up below this upper break even point, then my loss is unlimited, because I am a seller of an option. So that you need to be careful of. So maximum loss is unlimited if Bank Nifty expires below 41,100 or above 42,900, because your view went wrong and Bank Nifty showed a sharp movement, and hence you will make loss if it expires below lower break even point or a higher upper break even point. Maximum profit is 900 rupees per share if it expires dot at 42,000. So if it expires at 42,000 rupees only, you will make full 900 rupees as a profit, because both 42,000 call and put premium would become zero on the expiry day, because it had expired dot at 42,000. So at 42,000 level, you will make full 900 rupees. But also if it expires between this level of 41,100 to 42,900, you will make some kind of a profit in this strategy. So let us understand. As I mentioned, that if it expires between 41,100 to 42,900, you will still receive some kind of a profit in this strategy, which is in green. However, if it goes below 41,100, you will start making loss, which is unlimited. And if it goes above 42,900, sorry, if it goes above 42,900, yes. So here your loss is also unlimited. So this is a range bound when you expect that the time value you want to it down the time value of the options, because what will happen if market consolidates, and if it consolidates in a narrow range, then slowly and steadily the time value also decreases. So if you want to take benefit of the time value, then this is a strategy which you can do, short straddle. If you want to hedge this strategy, then you can just search upon iron butterfly strategy. Iron butterfly strategy is just an hedging part wherein you won't be exposed to unlimited loss, wherein short straddle you are exposed to unlimited loss. But if you do this range bound strategy with a limited loss, then you can do iron butterfly strategy, that you can just look upon on the net. You can just search upon, you will be able to understand how you can do. But for that, you first have to understand what is short straddle, and then it will be easier to understand the iron butterfly strategy, where there is an hedging lag involved in it, wherein you are not exposed to maximum loss. So now last is a very important strategy, is called as the hedging strategy, which is a protective put strategy. Now this strategy, who can do this strategy? First, an investor who have a big position in their portfolio and they have a fear that the market will fall from this level. They are exposed to a bigger risk if market falls significantly. For them, this strategy is very useful. Second, if you trade in a big quantity, like in e-margin or MTF, or if you have a big position in futures, if you want to hedge these positions, you can do this strategy. You can minimize your risk by doing this protective put strategy. So these are the two scenarios who can do this strategy. If you have a big holding, or if you have a big portfolio, or if you have a futures positions, then how you can safeguard that positions in a volatile market if it goes against you. So this strategy will help you to understand and to safeguard your loss. So protective is also called a put hedge, is a hedging strategy where the holder of a security buys a put to guard against a drop in the stock price of that security. When to create a protective put strategy is usually employed when the trader is bullish on a stock but wary of uncertainties in the near term. It is used as a means of protection. So here I have taken an example. Suppose you are bullish on ICICI Bank. Current market price, suppose it is at 900 rupees, and you are bullish on ICICI Bank, but you are also wary of uncertainties. If ICICI Bank goes down, then of course, suppose you have taken it's in future. If it goes down, then you're exposed to unlimited risk because it's in future position you have bought. So here, what you can do, you can buy 900 put option to safeguard. Suppose you buy it at 15 rupees. So to safeguard that, you have bought 900 put at 15 rupees. So since you are a buyer of a put option, your maximum risk would be 15 rupees. If ICICI Bank, how much ever it goes above 900 rupees, that means you will make unlimited profit in futures. But your put option, only 15 rupees would be at stake. If in case ICICI Bank starts moving up, you will just lose 15 rupees. But if ICICI Bank starts moving down, in future you will be exposed to unlimited loss. But since you have 900 put option at 15 rupees, that 900 put option will give cushion to your loss and will protect on the downside. So how much ever it goes below 900 rupees, the 900 put option will compensate you. So here your break-even point for this strategy is 915. Since you have incurred 15 rupees as a cost, you will add it into your prices on your future or stock positions which you are holding it at 900 rupees. You will add this hedging cost at the price which you have bought this future or future position. So 900 plus 15 is 915 is your break-even point. So ICICI Bank, once move starts above 915, your profit is unlimited. However, if it starts moving lower, your loss is just 15 rupees per share if ICICI Bank expires below 900 rupees. So suppose if it expires at 800 rupees also, if you do this strategy till expiry and you hold on to this strategy, then your loss would be just 15 rupees and not more than that, because you have hedged your position by buying 900 put option. So and if it goes lower, the 900 put option will safeguard you. However, your profit is unlimited if ICICI Bank expires above 915 rupees. It's a very good strategy to protect your portfolio, to protect your stock or futures position, and it can minimize your loss significantly and will also give you some amount of cushion to hold on to your positions at the bad times also, so that you don't panic and you don't square off your positions. You wait for the market to come up because you have already bought the put option and you are exposed to very limited risk into it. So same way, you can do a protective call strategy. Suppose you have a short positions in futures and simultaneously you can buy call option to safeguard your short positions if in case your view goes wrong. So this is a payoff chart. So here, as I made you understand, if ICICI Bank, if you do this strategy, and if ICICI Bank goes on or below 900 level, how much ever it goes below it, you will not lose more than 15 rupees per share. But if it starts moving up, 915 was your break even. Above 915 rupees, your profit is unlimited. So if it goes at 980, you will be making a profit of 65 rupees per share. So that's the beauty of hedging of the strategy. Basically, you are exposed to limited risk and you have unlimited profit if in case your view goes right. So that's it from our end. I hope you find this session very interesting on strategy part. There are various strategy which you can do in various market scenarios. So we have touched upon all the scenarios where you can, which kind of a strategy you can do. And now we'll open this forum for a question and answer section. So if anyone has any kind of questions and doubts on understanding any strategies, you can basically type on the question answer panel, which is there on the right hand side of your screen, and we'll reply you back. So there is one question from Mr. Murali. There is one question, but in HDFC, can we do it with 30,000? Bull call spread as margin is high. Mr. Murali, I'm not able to understand your question. Can you just simplify in a one sentence what exactly your question is? Yeah, there is one more question by Mr. Murli. Is can we do a basket order in HDFC? Example, bull call spread. Yes, Murli, you can do a basket order. How you can do it? Let us understand in HDFC Securities portal how you can do a basket order. So I'll just log in into my HDFC Securities portal. So it's only available in Entry and Empowered right now to do a basket order. I'll just log in with my credentials. So here it is an Entry Empowered portal. If you want to do a basket order, now firstly I'll make you understand how to use this basket order functionality. So firstly, what you have to do is you have to first understand how much margin is required if you want to do any kind of a strategy. So for that, go to hdfcsec.com and check the margin calculator under products. So if you go to hdfcsecurities.com, this is our website. Under products, just before login, you don't have to log in. Under products, there is a under derivatives, there is a margin calculator. Now, suppose you want to initiate bull call spread by buying 18,000 call and simultaneously selling 18,200 call option. First, check how much margin is required. So, I want to buy 18,000 call option. I will add, and simultaneously, I want to sell 18,500 call option. I will add, and then I will click on submit. So, if you see the margin requirement is 18,000 plus 400 rupees is a premium requirement. So net around 22,000 rupees of margin would be required. So now first what you have to do to So first what you have to do is basically you need to go to Entry Empowered and transfer that 23,000 rupees from your bank account to your trading limit. First you transfer it, then you go to equity, go to basket order. After going to basket order, there is one symbol of like settings over here. If you click on this symbol, you need to make one basket. You need to make one basket. Name as new basket and name as Nifty Bull Call Spread. So I will name it Nifty BSC. I will save this basket. I'll click on OK. Now I will have to add all these leg buy option index Nifty 18,000 call option I want to buy. So here, once you type 18,000 call option, you will be able to see what is the current market price of 18,000 call option. If you want to buy it at market, you can also buy at market and add this order. Then you want to sell 18,200 call option. You select the expiry, 18,000 call option you want to sell. Current market price is 43. You want to sell it at market. Click on market, add this order. Now, once you have done this, you need to save this basket and you need to place the order basket. You need to click both simultaneously. You can place this order and you can then execute it. So right now, there are two things. Now, if you want to take an advantage of the hedging benefit, because you have hedged you hedged the strategy by buying 18,000 call and selling 18,200 call option. So here, if you see, there is an hedging benefit. If you see this margin calculator, there is an hedging benefit of 62,000. You will be getting it. So if you want to take advantage of it, the first initiate a buy leg. Whatever the buy leg is, you can select this buy leg. You can first place this order in the buy leg and then initiate the sell leg and click on place this order. If you do this, you will be your strategy will be executed by 18,000 plus 4,000. That is by just paying 22,000 rupees. Your strategy would be executed. But if you want to execute both this simultaneously, then what will happen? A system will reject your orders, and additional margin of 62,000 would be charged plus 22,000. That means approximately 84,000 rupees of margin would be required. But if you don't want, first initiate a buy leg and then initiate a sell leg to initiate the strategy. And now once you initiate a strategy, now if you want to square off your strategy, always square off your strategy where there is a margin which will get decreased. So you want to sell the sell leg first and then square off the buy leg, because what will happen if you square off first the buy leg, then you won't be allowed to square off, because here also you will be asked an additional margin to bring in. So always recommended to square off your position of the strategy. First square off your sell leg and then square off your buy leg to basically squaring of your strategy becomes very much smooth. So that was all about basket order functionality. So Mr. Praveen is asking what time decay impact in bull or bear spread. So our time decay impact would be lower compared to if you are buying options, a plain vanilla options. That is, you are just going long on call option or long or put option. Here there will be high impact on your time decay. But if you're doing any kind of a spread, your time decay on the buying of options will reduce, but simultaneously you will also get benefit by whatever options you have sold. There also you will be able to get benefits. So net your time decay would be lower compared to if you are buying long call or long put. So that's why I can frame myself. So Mr. Rakesh is asking how one can effectively do intraday in futures only to earn profit. What type of measures one can take and minimize loss? So for basically there is no hard and fast formula, anything for basically if you want to profit and how you can successfully do it. But a few things which you need to make sure of whenever you enter any kind of in futures positions. First, you need to have a stop loss level in mind whenever you enter. First, you need to have a stop loss and a target level both in mind before entering into this position. After entering into the positions, if you define the stop loss and the target price, that is not fair. So what you have to make sure whenever you enter into a position, first search about what should be my stop loss, and second you should search about what should my target. So you will get an automatically answer that it's the risk reward ratio favorable to you. Then only you need to enter. Suppose you are buying it 100 rupees and your stop loss comes to 80 rupees, which is 20% lower, then the risk reward parameters is not at all favorable to you, and you should not basically you should not go for it ideally. If the risk reward parameters is favorable to you, then only initiate. Second thing, you should check basically your risk parameters very well tightly, and you should follow some kind of rules in the market. if you are studying technical parameters like RSI or anything, you should be comfortable with, and you should follow that kind of parameters which you need to first shortlist the stock. And the second thing, if you are seeing for an open interest, then also you should first predefine your parameters. That how you can this three parameters is my important parameters, and I will stick to it. And based upon that, I will enter and exit. So these are the few things which you need to you need to make sure once you are entering into kind of a position. Mr. Rakesh Gupta is asking minimum difference between buy and sell to cover the intraday expenditure. Are you talking about buying and selling leg? I mean intraday expenditure. I didn't got your point. So if you're talking about the time decay option, sorry, I'm not able to understand your question. So if you just elaborate. There is one question by Mr. Pushram. What is the profit capped on buying put? So if you are buying put, there is no cap for the profit. It is unlimited profit. Basically, how much ever it goes below the strike price which you have bought. Suppose you have bought 18,000 put option. So how much ever it goes below 18,000 put option, you will get that unlimited profit. So profit is unlimited. However, loss is just restricted to the premium which you have paid by buying the put option. Mr. Murli is asking also create basket in that first buy and then buy sell. So you can make a basket by just changing this buy leg to sell leg and sell leg to buy leg while squaring off a position, so that you can do it easily. Again, Mr. Murli is asking, and when square off, close the one which is in sell and then which is in buy, right? Perfect, Mr. Murli, you understood very correctly. So whenever you square off your position, first close the sell leg and then close the buy leg. So that you need to make sure that you are doing it, because first you square off the buy leg, it will ask you for an additional margin. If you don't have margin, then it will be difficult. You won't be able to square off. So always recommended to square off your sell leg where your margin will drop significantly, and then square off your buy leg. So Mr. Ashok Kumar is asking, what is the best for our trading options or intraday trading? So of course, intraday trading is a much riskier part in the day to day. It's very much difficult to make money. Options with strategies is a very good part to trade upon. Basically, it will help you to minimize loss. You will be hedged. Your positions will be hedged, and net you won't make money much, and also you won't lose money. So you have to basically either if you see the you are exposed to very limited risk. So it was always advisable, if you are exposed to limited risk, slowly and steadily you will start making money, and then you will be able to gain confidence. So if you don't have any kind of an confidence for a particular stock or index to buy, you always enter with the strategy. It is always recommended with the strategy wherein it will be helpful to you to earn slow and steady returns for that. So Mr. Rakesh Gupta is asking intraday expenditures of change in futures. So, so it is depending upon the brokerage. If I not understand, I'm not able to understand correctly. So it depends upon your brokerage basically. So whatever your brokerage would be, you have to cover that much amount of points. It should increase to cover that expenditure, and then only you will be able to make profit. So I also am not sure I have answered your questions rightly, Mr. Rakesh. I'm sorry because I didn't understood your questions properly. So we'll just wait for more couple of minutes. So if there are any kind of questions, we'll take that, address that, and then we will close the call. Mr. Ashok Kumar, is again how to edit the portfolio which has been created earlier. So yeah, so what you have to do, I mean, you're talking about this basket, how to edit the basket. So go to this basket order. If you want to add, you just have to select which basket you want to add. You can select this basket, automatically your two leg would be there. If you want to edit anything, if you want to delete this leg, you can modify this. There is a modification link given to you. So if you want to modify, if you want to delete this, you can delete. So right now there's some issue, you're not been able to modify. So what you can do, you can delete this easily, and you can modify your link whatever you want. Right now it's not been able to do because I think it will be able to happen the market hours. You can delete this link and delete this leg. You can save this basket, and then whatever basket you want to make, you can make a fresh basket over here. You can also make a new basket here. There are 5 baskets which you can make. You can name anything and save, and you can make the basket. So here you can do any kind of a modification part if you want to do it in the basket. Mr. Majar is asking, do we get any suggestions from HDFC for options daily or weekly? Yes, we do get a suggestions. You can check it in your mobile app. Also in this mTrade or mPower, if you go here also you will be able to see the recommendations. This is a research call section, and mTrade Empowered. If you enlarge this research call sections, if you go to technical calls, under that whatever calls, technical calls you want to understand, you want to see for derivatives only. If you see the derivatives call, then all the derivative calls would be there, whatever it is open right now. So you will see all the derivative calls. You can also see all the close calls also. So there was an index specific calls which we have generated yesterday, Bank Nifty, Nifty. Also there was an options call. So right now they are closed, so it won't you won't be able to play. You won't be able to trade on this. If you want, you can do, but it's not suggested by the research right now. So you will be able to see what are the open calls for it. So here you can check what are the open recommendations of the HDFC from our research team of HDFC. So I think there are no more questions. So we'll just conclude. We'll thank everyone for coming out and attending this session. I hope this was quite useful to you understand various option trading strategies. We also come out with every Thursday, we come out with the option trading strategies, and their performance is very good. So if you can also basically trade upon that strategy. Basically, you can ask your relationship manager to give the option trading strategy, which are basically recommended on every Thursday morning before the market. We recommend this strategy for approximately the time frame is 4 to 5 days. So in last 1 year, we have generated a strategy with 67% strike rate. So it's a very good strike rate. If you're not able to get this strategy, if you're not affiliated to any relationship manager, you can visit a Telegram channel in HDFC Securities of Telegram channel, wherein we are providing the strategy that, and you can initiate this strategy very much easily. So we'll request everyone to look upon it, and thank you and for attending this session. We will call for the day now. Thank you and have a nice trading day and have a nice weekend too. Thank you. Bye.